Inflation didn't scare policymakers in the 1970s, not at first. They believed it was temporary, cyclical, manageable, a side effect of growth. Until 1979. That year, a revolution in Iran triggered an oil shock that didn't just raise prices. It exposed a deeper fracture in the global financial system. It shattered the illusion that inflation could be nudged lower with polite adjustments. It forced central banks to choose between political comfort and economic credibility, and in doing so, it marked a structural break in the modern global economy. Welcome to the Financial Historian Fools, where money, power, and history collide, and nothing is ever as simple as it looks. This is the story of the 1979 oil shock, not just as a spike in energy prices, but as the moment the modern financial system was forced to confront its own fragility. Because 1979 wasn't about oil alone. It was about expectations, credibility, and the cost of restoring trust when it's already slipping away. To understand 1979, you have to begin earlier. In 1971, President Richard Nixon ended the Bretton Woods system by suspending the dollar's convertibility into gold. For nearly 3 decades after World War II, global currencies had been pegged to the U.S. dollar, and the dollar was pegged to gold at $35 an ounce. It was a system designed to create stability after the chaos of the Great Depression and 2 world wars. But by the late 1960s, the U.S. was running persistent trade deficits and financing both the Vietnam War and expansive domestic programs. Dollars were accumulating overseas. Foreign governments began converting those dollars into gold. The U.S. gold reserves were draining. So Nixon made a choice. He closed the gold window. The dollar floated. The world entered a new monetary era, one no longer anchored to a metal, but to policy. That shift mattered because once currencies float freely, discipline must come from somewhere else, from fiscal restraint, from credible central banking, from political stability. In the early 1970s, that discipline was thin. Then came the first oil shock in 1973, after the Yom Kippur War. OPEC imposed an oil embargo against the United States and other Western countries perceived as supporting Israel. Oil prices quadrupled in a matter of months. Energy costs surged. Inflation accelerated sharply across advanced economies. But here's the critical detail. The 1973 oil shock didn't create inflation. It amplified an inflationary environment that was already building. By the mid-1970s, the United States was experiencing something economists once considered nearly impossible: stagflation, high inflation combined with high unemployment. The old Keynesian playbook, stimulate during downturns, cool during booms, was struggling to explain what was happening. Inflation in the U.S. hovered around 11% in 1974. It eased slightly mid-decade, but never returned to the low levels of the 1950s and 1960s. The dollar weakened, and confidence eroded quietly. Policymakers believed they could manage it. They underestimated psychology. Inflation isn't just a number. It's a behavior pattern. If workers expect prices to rise, they demand higher wages. If firms expect higher wages, they raise prices. That loop becomes self-reinforcing, and once expectations become embedded, reversing them is not incremental work. It's surgery. By 1978, inflation was climbing again. The U.S. Consumer Price Index moved above 7%. Energy prices were rising. The dollar was under pressure. Treasury yields climbed. Markets were uneasy. The system was fragile before 1979. Then Iran exploded. In early 1979, after months of mass protests, strikes, and political paralysis, the Shah of Iran fled the country. Ayatollah Ruhollah Khomeini returned from exile. The Iranian Revolution reshaped not just Iran's political structure, but global energy markets. Iran was one of the world's largest oil producers. Its revolution disrupted production dramatically. Output fell by roughly 4 to 5% of global supply. That may sound modest. It wasn't. Oil markets operate on tight margins. When supply is constrained and demand remains steady, price responses can be violent. Oil prices surged from around $15 per barrel in 1978 to over $39 by 1980 more, then doubling in less than 2 years. The shock rippled outward. Energy is not a luxury input. It is foundational. Transportation, manufacturing, agriculture, heating, every sector absorbs energy costs. When oil prices rise sharply, the entire cost structure of an economy shifts upward. Inflation in the United States reached 13.3% in 1979. By early 1980, it approached 14%. The United Kingdom saw inflation near 18%. Across Europe, double-digit inflation became the norm. But the most dangerous shift was not the price spike itself, it was belief. Consumers expected prices to keep rising. Workers negotiated contracts assuming persistent inflation. Businesses built price increases into forward planning. The inflation psychology became entrenched. And once inflation expectations detach from policy credibility, you're no longer adjusting the economy, you were chasing it. By mid-1979, the U.S. Federal Reserve was facing a credibility crisis. Markets doubted its willingness to contain inflation. The dollar weakened further, bond yields rose, and gold prices surged above $800 per ounce by early 1980, a powerful signal of declining confidence in fiat stability. In August 1979, Paul Volcker was appointed chairman of the Federal Reserve. Volcker was not a charismatic figure. He was deliberate, tall, stoic, disciplined, and he understood something his predecessors had hesitated to confront. Inflation had become a structural problem, not cyclical, not temporary. In October 1979, the Federal Reserve made a dramatic shift. Instead of targeting interest rates directly, it announced it would target money supply growth. The implication was clear. Rates would rise as high as necessary to control inflation. They rose higher than anyone expected. The federal funds rate climbed above 17% in 1980. It would eventually peak above 19%. In 1981, mortgage rates exceeded 18%. Credit conditions tightened severely. This was not gradualism. This was shock therapy. The economy buckled. Unemployment rose above 10% by 1982. Industrial production contracted. Farm bankruptcies surged. Small businesses collapsed under the weight of borrowing costs. The housing market froze. And internationally, the effects multiplied. Many developing countries had borrowed heavily during the 1970s somewhere, and interest rates were lower and Western banks were recycling petrodollar deposits from oil-exporting nations into sovereign loans. Capital was abundant, credit was cheap, and optimism was high. Mexico, Brazil, Argentina, Venezuela, Chile, Peru, across Latin America, governments borrowed in dollars to finance infrastructure, industrialization, and social programs. Outside the region, countries like Nigeria, Yugoslavia, Turkey, and the Philippines followed similar paths. The assumption was simple. Growth would continue, exports would rise, and debts would be manageable. It looked sustainable as long as global interest rates remained low, but when Paul Volcker pushed U.S. interest rates above 15, then 18, then nearly 20%, everything changed. Most of those loans were denominated in U.S. dollars and tied to variable interest rates. As U.S. rates surged, so did their debt servicing costs. At the same time, the global recession triggered by tightening monetary policy reduced demand for exports. Commodity prices weakened, and dollar strength made repayment even more expensive in local currency terms. In 1982, Mexico announced it could no longer service its debt. Panic spread quickly. Brazil and Argentina soon required restructuring. By the mid-1980s, much of Latin America had entered what became known as the Lost Decade, a period of stagnant growth. High inflation, currency collapses, and painful IMF-focused austerity. Real wages fell, poverty increased, and hyperinflation erupted in Argentina and Brazil later in the decade. Political instability intensified as military regimes and fragile democracies alike struggled under austerity imposed by IMF restructuring programs. And the crisis did not stop in Latin America. Poland faced debt restructuring. The Philippines experienced severe financial strain. Nigeria, heavily dependent on oil revenues, entered its own debt difficulties. Several African nations faced similar pressures as dollar strength and falling commodity prices squeezed budgets. The shock radiated outward because the global financial system had become interconnected through credit. The pain wasn't temporary. It reoriented entire policy frameworks towards structural adjustment, privatization, and tighter fiscal discipline. It also deepened distrust of foreign capital in many emerging markets, a memory that still shapes policy choices today. The 1979 oil shock had triggered more than inflation. It had exposed leverage. High energy prices fueled inflation. Inflation forced rate hikes. Rate hikes stressed debt. Debt stress triggered defaults. Defaults reshaped global finance. This was the structural break. Before 1979, policymakers still believed inflation could be managed with incremental adjustments. After 1979, central banks internalized a different doctrine. Credibility must be defended at almost any cost. Volcker did not ease inflation lower. He crushed it. By 1983, inflation had fallen below 4% in the United States. The economy began to recover. But something fundamental had changed. Monetary policy became dominant. Central bank credibility became sacred. Inflation targeting became institutionalized. In the decades that followed, the memory of the 1970s haunted policymakers. It shaped the behavior of future Federal Reserve chairs. It influenced the Bank of England, the European Central Bank, and central banks across the developed world. The lesson was simple and brutal. Once inflation expectations break loose, restoring stability requires pain. And pain reshapes systems. The 1979 oil shock wasn't just a commodity event. It was a psychological rupture. It forced the global financial system to confront the consequences of monetary drift in a world no longer anchored to gold. It marked the transition from a post-war industrial growth model to a more financialized, capital flow-driven global economy. High U.S. interest rates strengthened the dollar. Capital flowed into American assets. Manufacturing competitiveness shifted, and financial markets gained influence. The system recalibrated. But recalibration always comes with winners and losers. By the early 1980s, inflation had been crushed. But the world that emerged from that victory was not the same one that entered the crisis. When Paul Volcker forced interest rates above 19%, he did more than slow price growth. He redefined the hierarchy of priorities inside the global financial system. Growth would no longer come first. Employment would no longer come first. Political convenience would no longer come first. Credibility came first. That shift may sound technical. It wasn't. It changed how governments borrow. It changed how currencies compete. It changed how markets price risk, and it changed how citizens experience recessions. Before 1979, inflation was tolerated. It was inconvenient, but it was often viewed as the cost of expansion. After 1979, inflation became the enemy. Central banks were no longer passive managers of liquidity. They became guardians of stability, sometimes at the expense of short-term prosperity. And here's where the structural break becomes visible. In the aftermath of the oil shock and Volcker's tightening, capital began flowing into the United States at scale. High interest rates attracted global savings. The dollar strengthened dramatically in the early 1980s. This had cascading consequences. A strong dollar made U.S. imports cheaper and exports more expensive. American manufacturing struggled under the weight of currency appreciation. Meanwhile, financial markets expanded. Bond markets deepened, derivatives grew more sophisticated, and capital became more mobile. The 1980s did not just mark the defeat of inflation. They marked the rise of financialization. Wall Street grew in influence. Debt markets became central to economic expansion. Corporations increasingly relied on credit engineering rather than purely industrial output to generate returns. Governments leaned more heavily on bond issuance. The system became more leveraged, but also more disciplined, at least in terms of inflation control. Inflation remained relatively subdued for decades afterward. Central banks internalized the trauma of the 1970s. Every uptick in consumer prices triggered hawkish reflexes. Interest rate credibility became a tool of geopolitical strength. Energy shocks remain potent. Inflation psychology remains dangerous, and monetary tightening remains painful, but debt levels amplify consequences. The lesson of 1979 is not simply that inflation can be beaten. It is that beating it requires sacrifice. Volcker accepted unemployment above 10%. He accepted recession. He accepted political backlash. Farmers drove tractors around the Federal Reserve building in protest. Legislators criticized him openly. Businesses collapsed, but inflation fell. And once credibility was restored, long-term interest rates gradually declined. Growth resumed. The dollar's role as the world's reserve currency strengthened. Stability was re-earned. The question today is not whether inflation can return. It can. Energy markets are volatile, geopolitical tensions persist, supply chains remain fragile, and climate disruptions affect food and commodity production. Strategic choke points still shape global finance. The question is whether modern policymakers are willing or able to endure the level of pain required to reset expectations. Nothing says stable system like needing a recession to prove your credibility. But that is the reality. The 1979 oil shock was a structural break because it ended an era of complacency. It revealed that inflation, once embedded, cannot be negotiated down politely. It must be confronted. And confrontation reshapes institutions. It also marked the transition into a more financially dominated global economy, one where capital flows, bond markets, and monetary credibility shape power as much as industrial production. Energy supply shocks exposed the fragility. Monetary shock therapy re-established order. The financial system emerged leaner, more disciplined, and more dependent on central bank authority. That authority still rests on trust. Inflation is ultimately a crisis of confidence. If households, firms, and investors believe money will hold value, stability persists. If belief erodes, prices accelerate. And reversing that belief requires action, not reassurance. 1979 proved that point with brutal clarity. History doesn't repeat line for line, but the structural pressures remain. Energy remains geopolitical. Debt remains high. Inflation remains psychological. Central banks remain the last line of defense. If you want to understand how money and power operate, not in theory but in practice, study 1979. Study the moment policymakers realized that credibility, once lost, demands sacrifice to restore. And remember this: the modern global economy was not shaped by smooth evolution. It was forged in moments of crisis when leaders were forced to choose between comfort and stability. In 1979, they chose stability. The cost was recession. The reward was restored trust. Every financial system eventually faces its test. The oil shock of 1979 was one of those tests, and it rewrote the rules. History doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers.